So the adjusted trial balance at Club Canada Wholesale Inc. contained the following accounts at December 31st, the company's year end. So over here, as we can see, we have a trial balance. A trial balance essentially just has all of the accounts in our accounting cycle, and it has the ending balances. So as you can see, we have cash, accounts receivable, notes receivable, merchandise inventory, supplies, land, buildings. Then we have accumulated depreciation building. We have equipment, then we have accumulated depreciation equipment. All these accounts that I've just listed, these accounts are assets. So accumulated depreciation is, so for instance, buildings and equipment, they usually depreciate in value, declined in value, and that's recorded through something called accumulated depreciation. Accumulated depreciation is a contra account. And remember, a contra account is attached to a primary account and it reduces its balance. So for instance, building 197,000 less accumulated depreciation of 93,575 is going to give us the carrying amount of the actual building. Then we have accounts payable, under revenues, income tax payable, and mortgage payable. These accounts that I've listed are liabilities, which are future obligations. Then we have common shares, retained earnings, which are shareholder equity accounts. Then we have sales, sales returns and allowances, sales discounts. If you scroll a little bit more down, we also have interest revenue as well. These accounts are revenues, which are income earned. And remember, sales returns and allowances and sales discounts, these are contra accounts. So remember, contra accounts are attached to the primary account and it reduces its value. And then we have cost of goods sold, administrative expenses, selling expenses, interest expense, and income tax expense. And these over here are expenses. These are the cost of doing business. These are costs that we incur, consume, and use up in order to earn revenues. So for this practice question, we have to do the multiple step income statement. I want you to pause it right now. Attempt it on your own on a piece of paper, and then resume my video and test yourself. So let's dive right into it. So this is a formal financial statement. It's the first one that we do. So remember, we did the single step in prior videos. However, in this video, we're going to do the multiple step, which is going to be the one that you're going to see on most companies' financial statements. So the first part is a three-part title. So we have the company name, Club Canada Wholesale Inc. Then we have the income statement, which is a multiple step. And then we have the date, the year ended December 31st, 2015. Remember, the income statement, the statement of changes in equity, or the retained earnings statement, and the statement of cash flows is for the year ended December 31st, 2015. The balance sheet is going to be just at December 31st, 2015. So that's the first step of the income statement. Then we're going to figure out the net sales. To arrive at the net sales, we're going to take sales of $922,360. Then we're going to subtract the two contra accounts, so less sales returns and allowances for $17,745. And just a quick recap, this is the totals column, and this is a subtotals column. Totals column over here, and then the subtotals column over here. So we're going to subtract sales returns and allowances, less sales discounts. Since we're going to add these two contra accounts together, we're going to do 17,745 plus 4,615 underline gives us 22,360. Then we're going to take sales subtracted by the total of the contra accounts to get 900,000. So that's step number 2. Step number 3 then is calculating the gross profit. Simply put, the gross profit is net sales minus cost of goods sold. So once again, the formula to calculate gross profit is net sales minus cost of goods sold, which gives us gross profit. So 900,000 minus 692,100 gives us 207,900. Then the next step is to calculate the operating expenses. So just to kind of rewind, cost of goods sold is taken from over here. And then we have administrative expenses, which falls under operating expenses. So operating expenses has administrative expenses, as selling expenses. It could also have like things such as depreciation expense, rent expense, salaries expense, etc., etc. But for this specific question, it's just administrative expenses and selling expenses. So administrative expenses is 116,115. Selling expenses is 5,900. We add these two together to get the total operating expenses. So once again, 116,115 plus 5,900 underline gives us 122,015. Then our gross profit of 207,900 subtracted by our total operating expenses, 122,015, gives us our profit from operations of 85,885. So now we're going to keep continuing forward. Now the next step is other revenues and expenses. So in this case, we have interest revenue, which is 2,400, and then we have interest expense, which is 8,830. So the solution here, so the thing is, depending on the question or the financial statements that you look at, there could be a difference between the brackets and the negatives. So in this case, what they're assuming is that interest revenue is negative because it's going to increase our overall profits. That's why. So what they're saying in this case is, since expenses is higher than our revenues, right? Just look at it that way. What's higher? Revenues increases our profits, interest expense decreases our profits. So we're going to do 2,400 minus 8,830 to get 6,430. Remember the underline. Since the expenses are higher than our revenues, our overall profit from operations is going to decrease now. So we're going to do 85,885 minus 6,430, which gives us profit before income tax of 79,455. Then we're going to derive the income tax expense to 15,500. So income tax expense is 15,500. Then profit before income tax, 79,455 minus the income tax expense of 15,500 gives us the profit of 63,955. Another word for profit is net earnings and net income. So essentially, dollar signs at the beginning of each column, as you can see, right? And then we have a dollar sign, a double underline on the final figure, which is the most important aspect of the multiple step income statement. So the multiple step income statement is important because we're deriving key variables now. Gross profit is essentially the direct profit of this company. Because remember, cost of goods sold is the direct cost of us purchasing the inventory, right? So gross profit, you could say, is a direct profit. So we want to have enough gross profit to cover our operating expenses and our other revenues and expenses as well. Then our profit from our actual operations, remember, these are our day-to-day operations, is 85,885. Then we have our profit before income tax, which is what we're going to take to calculate our income tax expense, right? In this case, it's given to us directly, but usually it'll be like a percentage. Like 30% of profit before income tax is going to be income tax expense, but in this case, it's given to us. And then we have our actual net income, our profit. So we're given various different metrics with the multiple step income statement, which is very, very useful.